Hi, and Assalamualaikum everyone. So, for this topic, I'll be talking about the Takaful versus conventional insurance. From here, we'll go briefly from the types and prohibition in Islam and differences for the both of these insurance and so on. So, I hope you enjoyed the sites that I compiled together with the explanation below. So, this is the elements of basic elements in the insurance contract. So essentially, insurance contracts include five elements, which by the first one is two parties, the insured and the insurer, which by the insured is the us and the insurer is the company. Two, an agreed premium, the premium we pay to the insurance company. And number three, an amount to be paid to cover a specified loss or losses, the total amount that will be paid in case there's a loss. Number four, the specified loss or losses should have a remote chance of occurring. And remote means that there's a little chance of it to occur among the participants. Number five, the policyholder who is taking out the insurance should have an interest in what is being insured for. Example, they could own the item they are insuring for. Example, like car or home insurance, fire and theft, and so on. Sharia versus man-made laws. So basically, there are three types of modern conventional insurance contracts that is unacceptable to Islam. In particular, life insurance involves the use of certain elements that directly contradict the rules of Sharia. One of them is al-maisir, known as gambling. Policyholder loses the premium paid if she does not claim or the loss does not occur. Or the policyholder may be entitled to receive a bigger amount than what he/she deserves compared to the premium. In other words, the insurance company promises to pay a certain amount of money indemnity to the insured if the risk occurs, and the insured agrees to pay another amount of money premium if the risk does not occur. So basically, they will be paying two types of amount of money to the insurance company. For Takaful, it is simple. Policyholders are deemed to donate a sum of money to help each other in case any one of them suffers a loss. So it will be equal for all of them. Another one is Gharar, known as uncertainty. It is against Sharia rule to sell any contract involving uncertainty, doubt, and probability. In Islam, it is prohibited in business contracts. For conventional, neither the insured nor the insurer knows when the loss will occur or what will be the amount. Alternatively, in Takaful, the policyholders fund is structured so that policyholders aid each other if a loss occurs. Another one is riba, known as interest and defined as making money on money. Sharia rules prohibit any activity involving interest. Most conventional insurers invest in interest-bearing assets, government or corporate bonds, and several businesses are restricted to an interest-free system. In theory, this means that Takaful entity must ensure that both its policyholder and shareholder funds must be invested in assets which do not have riba, and that any bank that the Takaful entity deals with should not be involved with the practice of riba. So I'll be talking about the distinction between conventional insurance and Takaful. Conventional insurance companies invest their funds in non-Sharia or interest-based instruments, while Takaful operators undertake only Sharia-compliant business investment, and the profits are distributed in accordance with the pre-agreed ratios as stipulated in the Takaful agreement. How does it be? How are the pooled funds invested? So for Takaful, operators will only invest in Sharia compliant instruments which are free from gambling, usur, and uncertainty. Uncertainty is the practices of Qarar, Maisir, and Riba are prohibited by Sharia law, while conventional insurance companies are free to invest in legal instruments like stock, bonds, etc. to maximize uh, pool profit for the participants. So for conventional insurance offers a loan to its insured and the loan granted is charged with a certain amount of interest. The interest is similar to riba since in Islam the lender is restricted from extracting any extra amount from borrower, while for Takaful in investments, participants act as a capital provider and Takaful operator as the entrepreneur responsible to manage the fund. For Takaful, it is shared among the participants and operators of a Takaful fund, while for conventional insurance, dividends are returned to the shareholders. But for both, doesn't mean Takaful is for Islam only. Takaful is for everyone, and that doesn't mean you need to be an Islam or Muslim to buy this Takaful insurance. Whereby conventional insurance, also we can buy the conventional insurance, but it includes the practices that are non-Sharia law, which that I just spoken, which is Qarar, that is uncertainty, Maisir, gambling, and Riba. So basically the difference between Takaful and conventional life insurance, although essentially both serve the same purpose which is providing coverage, there are major differences between the two can be seen as intent, investment and returns that I'll be talking about at my next slide. So first of all is intent. Individual that enters the agreement to contribute to a fund that can potentially help those experiencing the unfortunate situation. On the other hand, a conventional insurance policy is purchased as a personal financial security for an individual and the insurance company is the risk bearer. For example, me myself, I bought an insurance and then I had an accident which by it is covered by my pooled fund, which is the other participants that are in the same agreement of pooled fund. On the other hand, a conventional insurance policy is liable from the insurance company. For investment, the conventional investment units of insurance will invest based on the assessment of what fits their profiles. For example, today they are seeing that for company Genting is making a lot of profit. So they invest their investment units of insurance, which we pay, to the Genting shares, whereby Takaful investment will follow strict principles, which is under Sharia. Takaful cannot invest in anything that has elements of gambling, uncertainty, or the practice of lending money at unreasonably high interest rates. For example, Genting also we cannot invest because it involves gambling. So the practice of lending money at unreasonably high interest rates means that you loan for something that is for let's say 10,000 and you have to pay back let's say 100% or 200%, which by the loan will become total amount of 20 or more than what you are borrowing. For returns, if there is extra money because of low claim rates by insurers under Takaful, it will be distributed to participants, while the profit from investment will be distributed to both participants and shareholders. So what does it mean extra money because of low claim rates by insurance under Takaful? Let's say there's 10 people. So out of the 10 people, only 9 people had low claim rates. So let's say 10 of them paid per year is 1,000 ringgit. So for the low claim rates, it will be paid distributed to participants which is our insurance company, and to us evenly, no matter how much we pay in the pool fund, while the profits from investment will be distributed to both participants and shareholders. While the profit from investment for Takaful operator, they make money through performance fee or by sharing the surplus. But the total amount of payment from the surplus that Takaful operators get cannot exceed the amount that is paid to Takaful participants. Let's say they give you, for each Takaful participants, 200 ringgit for the surplus. So they cannot take more than the participants had. However, under conventional insurance, extra money and profits belong to shareholders of the insurance company. Okay, so this is very simple. For conventional insurance, the extra money that they invested does not belong to majority does not belong to us. They have the rights to give more to who, which is of course they give it more to the shareholders, which by they need investment more from the shareholders to grow their company. Okay, basically this is a simple illustrations on Takaful and conventional insurance. So for conventional insurance, risk is transferred to insurance company, resulting in uncertainty and gambling. Whereby you can see it starts from the policyholder, whereby we paid the premium to the insurance company, and then the insurance company goes to a non-Sharia compliant investment funds or insurance, which we said was involves riba or gambling and so on, and then it goes back to the insurance company, and the surplus, which by the profits goes to the insurance company and does not go to the policyholder. Only claims that will go to the policyholder. So for Takaful, risk is shared between participants. As you can see, between Takaful participants and Takaful administrator, which is our insurance company, we will pay the wakalah fee. So from the Takaful participants will be a Takaful pool, whereby from the Takaful pool will be not called as premium, it will be called as contributions. And from the Takaful pool, it will be invest in Sharia compliant investment, which by it is halal profits and goes back to the Takaful pool. So for the surplus, it is distributed as renewal discount. So on and so on. And then the claims from the Takaful pool from the participants will be paid for those who claim from the claim insurance company, whereby let's say me and Ali paid to the Takaful pool and only I claim. So a part of Ali's payment go to the claim and will be claimed by me. So I've taken this example from Takaful Malaysia. So how is Takaful and conventional insurance similar? Both Takaful and conventional insurance provide protection in the event of unforeseen events, and contribution must be made to start the coverage. Of course, you need to pay to start the coverage. Insurance is the transfer of risk by an individual or an organization, i.e. your business, to the insurance company. You or your organization will thus be known as the policy owner of the insurance. The insurance company receives payment in the form of premium will compensate you in the event of covered losses or damages sustained by you. Takaful provides protection based on Sharia principles. By contributing a sum of money to a common Takaful fund in the form of contribution, which is called tabarruk, you will undertake a contract that is called akad to become one of the participants by agreeing to mutually help each other should any of the participants suffer a defined loss. Let's say there's 10 people of you in the Takaful pool, you must agree for this Takaful that you mutually help each other, which by 9 of you did not claim any losses. Only one of you, and it will be distributed to those who claim. Both insurance and Takaful have similar basic principles. For instance, the insured must have a legitimate financial interest in the risk you are insuring, meaning you must suffer a financial loss when the insured event occurs. For example, you must suffer a financial loss means you cannot work or something like that. So your insurance or Takaful contract is a contract of utmost good faith, which is trust. Thus, you, as the certificate owner of Takaful insurance, need to disclose all material information required. If any of the relevant material facts are not disclosed, the certificate may be invalid and you cannot claim and be protected against any loss or damage from the Takaful pool. This is another example from Takaful Malaysia. Are there any difference between Takaful and conventional insurance? Unlike conventional insurance, which risk is transferred from the insured to the insurer, the Takaful insurance mutual risk is shared among the participants. Takaful operations are based upon the principles of mutuality, which is mutual, same, or in BM is samarata, whereby each participant makes a donation to a Takaful fund. In the event of its loss, the participant receives the amount of its claim. All investments managed by the Takaful operator are made in accordance to the Sharia law. This I have spoken which is Sharia law compliant and does not involve riba, garar, and maisir. These funds are managed by the Takaful operator on behalf of the participants, which will be the beneficial to the participants. On top of that, unlike conventional insurance, the participants retain an ownership interest in the Takaful fund. Contributions from the participants are later invested into a halal or Sharia compliant fund to derive investment income. In the event when the fund generates a surplus or profit, it is then shared among the participants and in turn compensates with the Takaful operator. This creates a win-win situation to all participants in this Takaful fund. The Takaful operator will also have a Sharia advisory board who will monitor the activities of the operations in order to ensure that it's Sharia compliant. This involves consideration of all aspects of the operation from the beginning to the end. Takaful and conventional insurance companies share the same objective, which is to provide protection to you, your loved ones, and your valuable possession, which is doesn't matter life insurance, car insurance, and so on, but it's Takaful which is Sharia compliant. So basically, the conclusion is Takaful is not a new concept. It has been around for centuries. Takaful business allows policyholders to enjoy the benefit of a mutual structure for all within a shareholder wrapper. Takaful business also has an explicit ethical structure which can be marketed to both Muslims and even non-Muslims. Although both conventional and Takaful business generate profits for the shareholders, in Takaful business the expenses paid to the shareholders are explicitly transparent, whereby in conventional insurance they are not necessarily so. So before I end the slides and my explanation for conventional versus Takaful, so here's the summary for both of it. So for benefits, it is paid from the related participant funds under mutual assistance for Takaful, and for conventional, it is paid from the company reserves. For investments, funds shall be invested in any interest-free Sharia-approved assets for Takaful, and for conventional, funds may be invested in any assets so long as they meet the required national insurance regulations and laws. For operations, operation mechanism shall be in line with the Sharia rules for Takaful, And for conventional operational mechanism shall be in line with the national insurance regulations and laws. For Takaful profit is generated from the return on the investment of the shareholder capital and expenses paid to the shareholders by the policyholders. And for conventional profit is generated from the company's underwriting profit plus any investment returns. For Takaful premium, paid premium is treated as both donation tabaru and saving mudarabah. And for conventional, paid premium creates an obligation against the insurer on a sale and purchase relation. For Takaful Shari'ah, under Shari'ah, Takaful practices are free from riba, gharar, and maisir. And for conventional, may involve riba and other elements which may not be justified by Shari'ah principles. And for policyholder fund, it belongs to the policyholders on collective basis and is managed by the shareholders for Takaful. And for conventional, all funds belong to the company, though separation of assets may be maintained between shareholders and policyholders for specific insurances, example with profits. For company in Takaful, company is better known as an operator, which acts as a trustee, manager, and also entrepreneur. And for conventional, relationship between the company and the policyholders is on one-to-one basis. So that's all from my side, that the difference between the conventional and Takaful insurance. So I hope all of you who are watching enjoys the slide that I have prepared, and Assalamualaikum.